Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monte, Chief Technical Analyst with Sticky Trades. And before we get into the charts, I just want to point out for those of you who are brand new that my chart analysis is based on a 7-point trading checklist. You have access to this. If you like, you can go to stickytrades.com, set up a free account. Doesn't cost any money at all. You could download this and then follow along with my weekly market reports as I go through the checklist with you. The geopolitical and economic news this week was very interesting. Fed Chairman Powell emphasizes the need for more evidence that inflation is easing before cutting rates. And there's even some speculation among those who are tracking the Fed that there is a small or slight possibility that the Fed may even increase rates to get ahead of this inflation. So stand by for that. You know, the employment numbers came out, and before everyone gets all excited, you have to understand that a lot of these jobs were created by the government. Now, this is from the U.S. Bureau of Labor Statistics, and I pulled this from their website today. That in March, employment in government increased by 71,000, which is higher than the average monthly gain of 54,000 over the prior 12 months. So, you know, the unemployment numbers and non-farm payrolls and those statistics are some of the most manipulated around. So it did move the market when the economic numbers came out. And another thing you have to factor in is that behind today's stellar jobs print, it was literally all part-time jobs. And I talked about this, that the number of full-time jobs are dropping off and people are picking up more part-time jobs. So it looks a lot like there is an increase in employment, but people are scrambling to make ends meet. Another thing to look at is credit card debt is surging to all-time highs. How many times have I reported on this? Well, as interest rates are going higher, people are having a harder time managing those minimum payments. Now, all consumers don't have the luxury like the Fed does to go print more money to pay their debt off. So, you know, they can't go in the garage or the basement and start printing money to pay the minimum balances on these credit cards. So it's only a matter of time where this bubble breaks, and it's going to be a big bubble, and the dominoes will come down pretty hard. I love comparing one chart to the next. Back in history in 1973, look at this pattern as it compares to 2024. This is almost a mirror image of what we saw back in the early 70s. And while we are taking shorter-term long positions, you could ask any of our equity traders or directional option traders, our longer-term option traders are positioned for a big downturn. Once that occurs, our put spreads are going to kick in overdrive, and it's going to be a very fun time. But in the meantime, we trade the trend. The short-term legs, as we call it, are basically what the swing traders are participating in. Now, because of inflation, gold is on the rise. We're setting record highs, and the central banks are buying gold. Silver is up. I'll talk a little bit about silver as we get to the end of this report. But for those silver bugs out there, you must be celebrating, and it's really been a fun time. But there's a lot going on in the precious metals, and maybe even more behind the scenes that we don't know about. But keep in mind, central banks are buying, China is buying, Russia is still buying, and a lot of the BRICS nations are buying as well. So this is very, very interesting to see the most recent rally in the precious metals. Keep an eye on the 50-day moving average. Let me explain this chart to you right here. Back in September of last year, we did have the 20-day moving average, which is that blue line. We had the 20-day moving average cross below the 50. This is about to happen as the Dow is now trading below the 50-day moving average. And so as long as that's happening, the 20-day moving average is rolling over and will eventually cross the 50. And that's going to trigger a lot of sell programs to put more pressure on the downside in the market. So that is the economic news that we have so far. But I want to do a quick shout out to one of our members, and this is Roby. He was able to donate another $1,000 to St. Jude after reading and learning about how to read charts. His trading is doing very well, and he has committed to taking his profits and giving it to charity. So thank you, Roby. And you don't have to thank Sticky Trades. Thank you for taking the time and effort to go ahead and learn about the charts and make money in the market. And really, that's part of our culture here. If you've been following along with Sticky Trades, we do promote passing it forward and giving to charity. Once you've taken care of your bills and your living expenses, it's always a great thing to go out there and help others who are less fortunate. All right, let's get to the charts. Here's the diamonds. And if you had a chance to follow along with the midweek report that went on Wednesday, I said keep an eye on these gaps. Keep an eye on the VIX, which I'm going to get to. We had a big downturn in the market yesterday, and we had just a little bit of a bounce on lighter volume. Now, that is a bullish harami. So early next week, I think we're going to trade up and test that 20-period moving average. And then I think we're coming right back down. I'll report more on the pullback on Wednesday. But Monday and Tuesday, I think we could go higher for the Dow 391.16. And I have a downside target after the pullback down here at 384.72, which I am not moving. Take a look at the oversold condition in the stochastic, and we have a little bit of a hinge going on in the CCI, hence the reason why I think we could go a little bit higher Monday and Tuesday at 391.16. Now looking at IWM, which is the Russell 2000 ETF, I still have my longer term downside target down here at $200.45. And like I said on Wednesday, watch for the gap fill. We filled the gap on IWM, and then we came right back down and pivoted from that gap fill. And we have a lower high, lower low. So this is a little bit different than what we saw on the Dow. And for IWM, I'm not going upside with that. I'm keeping the downside target at $200.45. So keep your stops in place as the 20-period moving average is acting as resistance. Looking at the tech sector through the Qs, which is QQQ, we have a bullish harami candle here, slight hinges on the stochastic and on the CCI, so I'm just going a tad higher on the Qs. I'm not going big, but 443.43 is my upside target for Monday and Tuesday, keeping the intermediate target at 429.91. Once we start to pivot lower, and I do believe we're going to have a lower high. Notice what's happening here. We have lower highs followed by lower lows. Get a little bit of a bounce and then a downturn from here. I think we're going to take out that low and then start to head on to that target on the Qs of 429.91. Looking at SPY, which is the S&P 500 ETF, it's going to be the same thing as what we just saw in the Qs. Bullish harami, hinge. I think we're going to go a little bit higher in S&P. Pull back from this high, which is from Thursday. So upside target of 521.01. And then just like the others, I think we're going to turn right back down and start heading to these downside targets of 498.67. As I mentioned on the midweek report, I said keep an eye on the VIX. Why is that? Well, look at that. We hit my upside target here on the VIX of 1588. But look down below, we have an open gap right there. And I think eventually that will fill, maybe not next week, but I do think that the VIX is going to start to pull back in an attempt to test this 20-period moving average. And again, go back and listen to the midweek report because I said that we could pull back and test that as a role reversal support level, which is exactly what happened yesterday. We opened right at the bottom of that candle, traded a little bit lower, bounced off of that 20-period moving average, rallied up, and now we have a half signal with that red candle on the VIX. Look at the hinge on the stochastic, look at the hinge on the CCI, hence the reason why I have a downside target on the VIX of $15.40. Now again, on Wednesday, we did the rapid fire stock analysis session. Every Wednesday, I ask the audience for ticker symbols, and through a rapid fire format, I go through and I analyze these stocks and I put price targets on each one of them. The blue colored cells are those stocks that have already hit their price targets since Wednesday. Now remember, we went over 75 stocks in that 1 hour period, and we had 27 star favorites. And what a star favorite is are the best of the best that we pull up on that Wednesday call. So if you're interested in participating in this rapid fire session, just tune in to Sticky Trades and you can enroll in that membership. And each and every Wednesday we have an action-packed hour. All right, now here's the lesson. First and foremost, I want to thank all of you for the added likes and comments In 1 week, we had over 600 new subscribers after putting some educational content at the end of the video. So we're going to do this again. The format is going to be go over the geopolitical and economic news in the beginning, go into the charts, talk about the targets on each one of the major markets, and then get into some education. Now, a gap is usually left through news or an earnings announcement or a jolt in the market. And what happens is 80% of the time when we're looking at gaps, and I'll look at IWM as an example here, 80% of the time after a gap has been formed, 80% of the time the gap fills, and then after the gap fills, 80% of the time from there, it reverses and goes lower. And that's exactly what we had happen after the gap fill yesterday. We had a gap on Tuesday, a gap down, we had a green candle, then it filled that gap initially in the morning, came back down, and now we're starting to pivot back up. So when you're looking at gaps, you look at them as price targets, but always remember that once the gap fills and the target has been hit, a lot of traders take the opposite side. And so if you have a gap that's still remaining above the market, those short traders are looking to short the stock once the upside gap is filled. And the opposite is true once a downside gap is filled. Here, the IWM gapped up, leaving a gap below the market. You see that? The gap was below the market. Look what happened after the gap filled. It filled on this day. 2 days later, we formed a pivot and rallied back up. So if you're looking at gaps as price targets, and you could remain patient enough for those gaps to fill, that gap fill point, once again, the gap has to be below the market and the stock is gapped up. Once those gaps fill, if you can remain patient, this is a great time to start scaling into positions. That's just strategy discussion. I'm not giving you individual advice on any particular stock, but it's the way we trade gaps. And if you look at SLV, again, those silver bugs are salivating right now. I have a 75% position right now. I sold a little bit yesterday, and that's mainly because these oscillators are starting to hinge and even pivot on the CCI. But look what I'm doing. I'm scaling out of the position to create buying power or cash available so that when these gaps down below the market fill here, and maybe even all the way down here, I'll get a chance to buy at those gap fill points and scale back in with a bigger position. So that is how we trade gaps. I hope you're enjoying this. Thank you again for liking, sharing, commenting. Please continue to do that. If you have any questions about gaps, put those questions in the comments field, and I'll be more than happy to answer those questions for you. So thank you so much, and I'll talk to you on the next video on Wednesday. So long.